Three outstanding local CPAs who are going to be helping us navigate this year's changing tax laws and also answering any questions that you may have about your individual and business returns. So first off, I'd like to go ahead and introduce them. First off, we have Ruth Elizondo.
Hi, how are you?
Great, thank you for being here. Adrian Brito.
Hello, Andrea.
And Theo Cabrera.
Hello, Andrea. Thanks for having us.
Thank you guys for being here. Our panelists are just a few of the CPAs who make up the El Paso chapter of the Texas Society of Certified Public Accountants, otherwise known as the TSCPA. Here is a little bit about what they do here in our community.
The Texas Society of Certified Public Accountants is a nonprofit representing Texas CPAs in public practice, business and industry, government, and education. The El Paso chapter of the TSCPA assists its members in reaching their highest professional potential and helps to build lasting, professional, and personal relationships at work and within the community. For more information, go to tscpa.org.
Now that we've introduced you to our panelists, we'd actually like to get to know each of them a little bit more. They each have their very own specialties, so we're going to talk with each of them a little bit more. Ruth, can you tell us a little bit about yourself and what things you specialize in?
Sure, Andrea. I have 20 years of experience and 10 years with my own business. Since I'm from Mexican background, I specialize with international accounting, especially here in the border. Obviously, I mean, it's easy to see people coming to the U.S. from Mexico and from the U.S. to Mexico to do business. So basically, that's what I do, a business and individual consulting.
Excellent. And Adrian?
Yes, so I'm currently a tax shareholder with Lauterbach Borsheim Company. I specialize with big business, partnership, corporate type taxation, along with mid to high level net worth individuals as well. So.
Excellent. Well, thank you for being here. And Theo, can you tell us a little bit about what you specialize in?
Sure. I'm with SBNG. We're a local CPA firm. We've been in practice for over 40 years, and our practice is comprised of tax clients and audit clients in particular. My particular area of expertise is in the audit side, so I spend the majority of my time helping construction companies, nonprofit organizations, and local governments get through their financial statement audits, and this time of the year I reserve for tax preparation.
Excellent. Well, as you guys can see, we have a wide variety of specialists here on our panel, and they should be able to answer most of the questions that we have coming in today. But in addition to this group of CPAs, we actually have a group of CPAs that are here to answer your phone calls. They're on a telephone bank here behind us. They'll be here for the next 2 hours. You can call them by dialing in the number at the bottom of your screen that should be appearing here shortly. That number is 881-0013. Again, the number is 881-0013. You can call them and they should be able to answer any questions that you may have specifically. We also are streaming live on our Facebook Live today with KCOS, and we will be taking any questions that you might have on our Facebook live stream, and those will get brought to me so that we can ask our panel. So we have a lot of great things and opportunities for our guests and our viewers to interact with us today. First off, I would like to thank today's gracious sponsor. We would not be able to have this show without our sponsor, and we would like to take a moment to thank them for their generosity.
We as an organization, the EFWA, really primarily give scholarships to women. All of our future goals involve helping women get into an industry, get into a profession that they can believe in and that can offer that security to them in the future. The chairman of the board of this organization is a past scholarship recipient. She was a single mom, couple of kids to raise. She is now a PhD, teaches at Baylor.
Well, it's already here, tax time. People are already ready to file if they have not already started the process. So what are a couple of the earlier questions that you are getting from your clients?
Probably some of the early questions now that we're getting, especially with the recent news and what's happening in Washington, is can I bring my stuff in, and when will my taxes get done? Currently, as we learned, the government shutdown as of Friday had been temporarily suspended. So for the next 3 weeks, it's business as usual in Washington. So IRS has scheduled e-filing for January 28th, which is tomorrow. So they'll start accepting tax returns. So if I had any type of conversation with any of my tax clients, is bring in your stuff, let's get it in the system, and we'll e-file as soon as we can.
As we were kind of discussing earlier, obviously the shutdown's been lifted. Things should return as normal. One of the larger concerns initially was that there was no one answering phones at the IRS, even though there were some people working. Would you guys advise someone to call the IRS this week? Would that be advisable if they had questions?
It's going to be hard to get through to the IRS this week. A lot of tax professionals over the last 3 or 4 weeks, because of this shutdown, have been trying to get through with questions and trying to contact people at the IRS. They're probably going to be full steam ahead this week, and those phone banks are probably going to be filled. So I would recommend wait a week and then try to get through after that.
Or perhaps just wait and get in touch with your CPA. They might be able to answer some of the questions that you had for the IRS in the first place, right?
Definitely.
Awesome. Okay, so now we said to expect our refund. We still should be expecting that on regular timetables is what they've told us, correct?
Originally, they have been said, or it was being saying that that refunds were not going to be issued while the government was shut down. But the IRS said that no, that refunds are going to be expected as always.
Okay.
If you are electronically filing, generally it takes like 2 weeks to receive your refund, sometimes even less, like a week and a half. And if you are just mailing your tax return, it can take 4 weeks.
Okay, excellent. So during that shutdown period, some people may ask if they didn't make their estimated payment for business purposes on the 15th because the government was shut down. When can they make those payments?
The IRS still expects you to make the payment on time. So if you have not done your estimated tax payment for January 15th, please go ahead and do so immediately as soon as possible. Also, they have not made any notices extending any deadlines. Just a reminder, the deadlines for filing W-2s is coming up on January 31st, and also the deadline for filing fourth quarter 941s.
Okay, well, now we're going to get into the meaty part of this conversation. There have been a lot of tax changes since last year. This will be the first year that taxpayers will see the changes enacted from the Tax Cuts and Jobs Act, otherwise known as the Trump tax plan. So let's go ahead and get a little bit into what changes that we're going to see on our tax refunds as individuals this year.
One of the major changes has to be the doubling of the standard deduction. So usually people, when they think of deductions on their individual tax return, they'll probably think of an itemized deduction. And the reason it's called itemized is because you have to elect to take that deduction over what's called a standard deduction, a deduction anybody can get. Well, that's doubled. For married filing jointly was around $12,000 in 2017. Now for 2018, up through 2026, it's doubled to $24,000. What that means is a lot of people that had itemized before are probably going to get a bigger refund this year or pay less in tax because of the doubling of that standard deduction.
So for people who are used to itemizing their tax refunds or tax returns, it may not be in their best interest this year. Is that essentially? Yeah,
so some of the itemized deductions that people take are taxes, real estate taxes, state income taxes, also sales taxes, and we can get into that because there's a change there as well. Mortgage interest deductions.
Which is a big one. That's a big one here in this area. Charity as well, is that?
Donations.
Charitable donations, okay. Yeah, medical expenses. Those are all itemized deductions. Well, if the aggregate of those that you can take on your tax return doesn't go above that $24,000 threshold if you're married, then you're probably going to take that standard deduction, where in prior years you probably didn't.
What's the threshold for single filers on that?
It's currently $12,000.
12. Okay, so married it's 24 and 12 for singles. Okay, excellent. Let us also discuss. Let's see here. So we discussed whether people will be itemizing or not. Let me ask you guys: how are the state and local taxes limited this year?
Well, normally there was not a limitation as to this deduction. So if you're elected to take itemized deductions in Schedule A, you could deduct all the property taxes that you paid and also all state income taxes. So if you live in a state like New Mexico, for instance, in which you have to pay state income tax, you would be able to take a deduction for this. Now, going forward, this deduction is going to be limited to $10,000. It does not affect most of the people residing in this area. However, those that are residing in New Mexico that used to claim more than $10,000 for New Mexico income tax would see a limitation on this.
Okay. Now, another question of things that may have changed, I know, is some of the healthcare tax credits and whatnot. So, can you go ahead and describe a little bit about what a health savings account is and if it's tax deductible?
Well, a health savings account, think of it, is generally like a trust. But like, for example, if someone doesn't know what a trust is, you can think of like a checking account that you open, that you contribute to, and then sometimes they even give you like a checkbook or a debit card that you can use to spend, but it's only for medical expenses. So if you have a high deductible health insurance, like $5,000, $6,000 or more than that on your deductible, then you can apply and obtain a health savings account. And any money that you contribute to that account is going to be tax deductible.
Okay, so
but it's only for medical expenses.
Okay.
Yeah, to go along with that, when you take the money out and it is for qualified medical expenses, it's not taxable. So you don't pay taxes on that amount. You get a deduction right up front, and then you don't have any income pickup if you use it for qualified medical expenses.
Yeah.
Okay. Again, I just want to remind the audience that if you have any questions for our panel, make sure you go ahead and give a call here, 881-0013. Again, that's 881-0013. They're very lonely over there, and they'd love to answer some of those tax questions as we go through. It's going to take us a while for our panel to move through those questions, but if you have something very specific that you want to ask, go ahead and give them a call. Back to healthcare. Did we need to go ahead and have healthcare for all of 2008? I know that there was a penalty, and then I heard maybe on the news that there might not be a penalty. So can you go ahead and explain that for our viewers?
Well, I can start explaining it, and then maybe you guys can jump in. So the individual reporting mandate is still applicable for 2018. So what that essentially means is that you're still expected as an individual to have health insurance for you and everybody in your household for the entire year. And you're expected to report that in your individual tax return. If for whatever reason you were not covered for a portion of the year, then the penalties may be apportioned depending on how many months you were without coverage. Okay. The mandate will go away starting in this year, in 2019.
Yeah. So this will be the last tax year that that will be essentially like you can get dinged on that. Is that correct? Penalized. Thank you.
Penalized for not having health
There
insurance.
we go. All right. I told you all that I was a tax novice, so you'll have to walk me through this. Okay. So this will be the last year. Now, one of the things we did touch on briefly was whether or not you could deduct your entire mortgage payment from a rental property. So that's a little bit different than your mortgage interest. So this is a mortgage payment into rental properties. We go ahead and touch on that real quickly.
Of course. So with mortgage payments, it's comprised of several components. There's the insurance component. There might be some tax escrow. There's the actual interest on the loan. And then there's the principal payment. When you have it on your personal residence, what's an itemized deduction, what goes on Schedule A, would be just the interest component and maybe the escrow tax as well. For a rental property, it's the same thing. The only thing is no longer an itemized deduction. It goes against the reduction of your rental income for that property, but only the interest portion. It's not the principal. And sometimes people get confused on that. They make a payment of $1,200. They don't realize that some of that's going to pay down the loan. That's not deductible. Only the interest component of that portion would be deductible.
Okay. Now, on that note, with rentals and on home ownership, one of the other big things that we were discussing before the show started was actually moving expenses, and how that may have changed this year. So say, for instance, you just moved into El Paso, you got a job here. In prior years, you could claim those moving expenses, but this year that's different. Is that correct?
That is correct, yes. My sister happened to just move this year, and she was really surprised because she got an assistance payment from her employer to move to Dallas. And unfortunately now those payments will be taxable, as opposed to in other years in which they were considered to be exempt, as long as you could show that you were using those funds to cover your moving expenses.
Relocate.
There is one exception, though. If you're in the military, you will still be exempt for any moving.
Which is really important for people in this area, obviously, because that's a large chunk of our moving population here is military reassignments. Okay, so that is one of those important things. Now, say for instance, this year, we've had a couple of large windstorms, some things that may have been considered local natural disasters, but they weren't really, declared as such federally or whatever. So a tree falls on my house. In prior years, you could deduct those expenses from your taxes. That again has changed this year. Is that correct?
That's correct.
Okay.
We're not going to longer be able to deduct the casualty and theft expenses. Like even if someone breaks into your house and you have to make repairs, or they stole some jewelry or stuff like that, you were able to deduct the loss. But now you are not going to be able to deduct any of that, except unless the government, as you said, the federal government declares your area as a national disaster area.
So say, for instance, if we have people that maybe moved from Houston and they ended up having a severe loss in Hurricane Harvey or something of that nature, they would be able to claim that loss because it was a federal natural disaster. But obviously here we haven't had any natural disasters claimed here.
Thank
so
God.
Right. We do have some really bad hailstorms, but yes, okay. So that was one of those big questions. Now, another thing, let's just go ahead and go into some of the dependent claims on our tax returns. One of the things that I think we touched on just privately beforehand was talking about how the exemptions have gone up so high that claiming your dependents, it's not going to change no matter how many kids you have. Can you explain that a little bit more?
So exemptions are gone. In prior years, we used to get about a $4,000, $4,150 exemption. It's kind of just like a write-off for each dependent we had claimed on our tax return. Well, that exemption amount is gone. What's kind of taken its place is the child tax credit. It's now doubled, and more people now are going to be able to claim that child tax credit because the income threshold has risen. I think it's $400,000 for people married filing jointly and $200,000 for single filers. That means if you make below that threshold, you get that credit for that child. Now, the child has to be under the age of 17, so 16 and below. You can also get a $500 tax credit for dependents that you claim that aren't children, that don't qualify as a child. So they've replaced it for children under the age of 16. I think it's a bonus for people. I think the credit's worth more than the deduction. But for all other dependents, it's not. I think it's a loss for the American people there. Yeah.
So I still cannot claim my cat, as you guys said it, but actual children or people that you're caring for that have Social Security numbers, you can claim that. What can you tell me a little bit about what expenses would qualify under a child care credit?
Yeah, so there's things called child and dependent care credits, and you can get that credit if they are a dependent of yours. Okay. That's available for taxpayers in the current year. So.
And those are like things like after school care or babies, that sort of thing. Is that correct? And
that's correct. It has to be, for example, if you're working.
Okay.
If you're married, both parents need to be working, because if one, like for example, only the father works and the mother is a stay-home, and they still take their baby to the daycare, and that's not deductible. Both parents need to be working, and it's like daycare expenses after school and extracurricular activities.
Okay. And you should get a tax form from your child care provider that will have all that information that goes on to your tax
If you
refund.
don't get a form, at least ask for a letter or something, a receipt or something that It specifies the total amounts paid through the year.
Okay.
And you need to make sure that the legal name of the business and the tax ID is there, or the social security or the person of the person.
Okay.
Yeah, and the amount that you get a claim, it's either 35%. It's a credit, so it's a dollar for dollar deduction. It's either 35% of amounts that you can claim as child dependent care up to a certain amount. I think it's $3,000 per child. It could be reduced down to 20% depending on your income. Most people will get that 20% deduction.
Okay.
Or credit.
Credit.
Rather, yeah.
And so when you're like, say for instance, doing it online or whatever, that should automatically calculate it. And when you enter in all of your formulas and everything from your from all your 1099s and everything, correct?
Yes.
Okay, great.
It should.
It should. All right. In theory,
yes.
right? Okay, excellent. Now, moving on to that, after the dependents, what are some qualified education expenses that are still eligible?
Well, we have the tuition for higher education, which is like university, college, and we have like different credits that we can take depending on the age of the student. Like for example, if you are a new student, we have 1 credit. If you are like someone that wants to decide to go to college again or to do your master's or something else, we have the what is it called? The
lifetime learning
credit. That one.
Right.
And it's generally for tuition and other expenses directly related to your education.
So books and all of that would also qualify into that education. Okay.
Yeah, one thing that doesn't qualify, I get this question all the time, is room and board, and that's one thing that doesn't qualify. But books, fees that you pay to the school, tuition is a big thing, so those do.
In order to claim these credits, it's really important that you do get a Form 1099-T from the college or university that you're attending, and that form normally will include any scholarships or any awards that the school is giving you to offset the cost of your tuition.
Okay.
Yeah, because obviously you will have to deduct that from the tuition to take the credit.
Okay. And so that actually ties it back into my next question, which was, what's the lifetime learning credit? So we just covered that it's for returning students or people that are going for their higher degrees. And so how does that credit differ from the other education credit?
Yeah, so you have the American Opportunity Tax Credit, and you have to be in your first 4 years of college. It's the better credit because you can get up to $2,500 per person. And that $2,500 is realized pretty quickly. So you get 100% deduction for the first $2,000 of expenses. Again, it's a credit, so dollar for dollar deduction. And then you get 25% for the next $2,000, so you can get up to $2,500. The lifetime learning credit's available to everybody. You don't have to be a full-time student or a half-time student. You can take 1 course or 2 courses, and you can take it for, it's called the lifetime, you can take it for as long as you're incurring those tuition expenses. Now that one is 20% up to $10,000, so it's harder to get the full amount of credit for the lifetime, but it's available to everybody.
So it's still out there for people that are maybe just wanting, are slow going back to school.
Right.
So
yeah.
Okay, excellent. Now, one of the things that we were kind of talking about was alimony. People that maybe got divorced in the last year, I don't believe that Texas has alimony payments. However, there are some other things that would be considered kind of alimony type payments, which would be maybe you're paying for college for a student. It's not necessarily child support, but it's outside of that realm. What differences are, I guess, if you can deduct those still this year?
Sure. This is a really interesting change that's going to become effective in 2019. And like you're saying, an alimony agreement can be fairly complicated, and there could be certain payments that could be considered an alimony in lieu of an actual monthly allowance. Something that has always been the norm is that child support is not taxable to the recipient of child support, and it's also not deductible to the payer of the child support. However, the rest of the alimony normally is a deduction taken from your taxable income. Well, for any alimony agreements that are entered into starting in 2019, those alimony payments will not be deductible anymore.
Okay. Now, I'm considering, say for instance, going to work for a different company. I have a 401k retirement account at my current employer. What can I do with my retirement account? What would you recommend for those people that are considering changing jobs with that 401k?
Well, generally, if you take your money out of a retirement account when you are 59 years old or less, you have to pay a 10% penalty. So if you take the money out, you need to think that you are going to have to pay next year in your income tax 10% of that money. The best way to go is obviously to roll it over to another account, but you need to be very careful because sometimes if you decide to leave a job, they just send you the money, but you still have 60 days to roll it over into another account.
And those would be accounts like Roth IRAs or regular IRAs. What are the difference between the Roth IRA versus the typical IRA account?
You want to answer that?
Sure. So a traditional IRA, it depends on when you're taxed on the actual amounts going into the IRA. A traditional IRA, you usually pay, you get the deduction up front, and then you pay when you take the cash out when you retire or you start taking those draws. Where a Roth it's the opposite. And so it really depends on when you pay the taxes. With the Roth, you pay up front, so you use already taxable income to fund the Roth, but when you take it out, it's tax-free, including the earnings that you've earned over the lifetime of that Roth IRA.
So in some sense, it might be better to go ahead and do the Roth because then you're not paying the lifetime of the taxable amount when you're withdrawing.
Right. It depends.
Okay.
Because, for example, most of the time when you're working, supposedly you are in a higher income bracket than when you are already retired. So obviously, like for example, a simple IRA or a 401k or something like that, that's why they are deductible when you contribute to them, because you need the deduction right now because you are paying taxes on all of your income from your wages. And when you retire, when you get the money out, you start paying taxes at a lower bracket because you are supposed not to have enough. I mean, you are supposed to be in a lower bracket than when you are working.
So it's taxable off of your income, not off of the amount that you're rolling into the account. Is that correct?
It's taxable at the time in which you take the money. So with a regular IRA, the amount that you contribute into the IRA this year will deduct your taxes this year. However, when you retire, when you're 65 years old or 67 years old, you will begin to withdraw those funds and you will pay taxes at your rate in that moment in time.
And I'm sure whenever you're making these large decisions, again, like changing jobs, having 401ks, needing to roll those over, it again is advisable to seek out your CPA, your tax professional, or somebody at your bank or credit union to have these discussions of what will be best for you in the long run, correct?
Right. Yeah, especially now with the changes in the tax law. There are going to be conversations you're going to have with your CPAs on whether or not to claim a dependent. And some of those things have to do with IRAs as well. If you don't claim a dependent because the credit's not worth the amount that they can get back from withholding that they had on their paycheck, they might have to claim themselves. And if you have an IRA for them and they don't really pay any tax, then it's probably a good idea to go the Roth IRA way with them rather than claim them on it as a dependent and do a traditional for yourself. So there's going to be a lot of conversations that we haven't gone through with our taxpayers as CPAs because these things have changed, and I think going forward it's going to make a lot of difference in the amount of taxes people pay.
Okay.
And also to touch on that point, aside from the tax consequences of all of this, it's really important that as an employee you understand the way how the 401k plan that your employer offers is set up. Many employees don't realize that if they leave the company before a certain amount of time, they may not be entitled to take all the money that's in there. Usually the money that the employee puts in there is vested immediately, which means that if you decide to leave the company after a year or less than a year, you can take those contributions with you. But normally the matching contributions, which is the part that the employer puts in there for you, they are normally subject to a vesting schedule, and it typically is 4 to 5 years. So it's something really important to consider when you're thinking about changing jobs. Also for those younger folks in the workforce, those in their 20s or early 30s that are in their first job, second job, it's really important they realize that it's important for them to start saving as much as they can. And I guess the gold standard for saving for retirement is at least 10% of your income every month.
If only, right? Yeah, millennials. Okay. One of the things as a young person, I'm going to kind of go off script here, but people that are maybe in their first jobs out of college, when they're filling out that W-4 form with their tax withholding, I know that's one of the questions that I get a lot just from my peers is how much should I claim on my withholding for those forms? Is there a magic number that you guys recommend for first time or, people that aren't used to filling those forms out? We're a little nervous.
Generally, like for example, if someone approaches me with that question, and if I know that the person is single, like for example, someone that just came out of college is single, they don't have dependents, their tax is going to be a little bit higher because they have less deductions. Like we just talked right now, right. A single deduction, the standard deduction is half of the married deduction. They don't have dependents. So we don't have credits, child tax credits, stuff like that. That is going to help them pay less taxes. So most of the time I suggest to them to put the max amount of the withholding in the W-4, and that's when you file single and zero allowances. That's the maximum withholding that they can take on your tax, on your paycheck, and sometimes it's even as high as 25% of your paycheck.
And ideally, they would get that money back in the tax return.
Of course.
Correct.
That money is gonna be like a little savings account, if you want to see it like that. That is gonna be sent
interest-free, though.
Interest-free that you wanna send to the government, and it's gonna help you pay for your taxes at the end of the year, and then they give you the money back if you overpay. Obviously, that's that's interest-free, as you just said. If you decide, you can put that money aside in a bank account, earn like 1, 2, 3% interest annually. But that's obviously up to you, and if you are like good enough to take your money and put it in the savings account, you can also do that.
And this year, with the tax brackets changing a little bit, you may need to go back, since it's January, and adjust those withholdings so that you don't owe more on your taxes in the future. Is that what you would recommend?
Yeah, and so what happened, especially in 2018, is the tax tables changed as well. What that means is your withholding amount, what you were withholding, probably people saw an increase in what they took home, even though they didn't get a raise. It's because those tax tables changed with the new laws because of the reduced rates. However, one of the things that you have to be careful with is that some assumptions were made when those tax tables changed, and you needed to fill out a new W-4 because the rulings on what a deduction was changed as well. A lot of people didn't do that, and so I think a lot of people are going to be surprised on how much they actually get back, meaning they might get back less than they think they will. The IRS has addressed this issue, though, in the last couple weeks, where they have said you are no longer required to pay in 90% to avoid the underpayment penalty. There's a penalty where if you don't withhold at least 90%, you have to pay this underpayment penalty. Well, they increased that threshold to 85% because they realized some people, when they filled out those W-4s, or they failed to fill out those W-4s, and those tax tables changed, that they didn't know the effects of that.
But I think it's important to note that they may have given us a grace period this year, but that will not necessarily be the case next year. So you really do need to adjust those W-4s out if you were coming up short on your taxes this year.
Exactly. Just go to your HR department or whoever's in charge of that and ask them for a new W-4. Read it, go through the deductions, and see where you land. I think it's very important to do that.
Excellent.
Yeah, and also as a customary practice, every time there's a major life event in your life, if you have another child, if you have another dependent, or if your civil status changes and you become unmarried, or if you get married, those are important situations in which you want to reach out to your employer and make sure you update your W-4s.
Now, one of the other questions that I get a lot from my friends who maybe are newly married is whether it's better for them to file jointly or single. What is the answer to that?
Well, actually, if you are married by the end of the year, like by December 31st, even if you got married that day, you have to file filing jointly for the whole year, even if you got married on the last day of the year. So sometimes even a suggestion is just to wait until January 1st if you don't wanna file together for that year. Because if you get married by December 31st, you have to file filing jointly.
So that's important to note for people, say for instance you live as a married couple but you have separate bank accounts and you keep your finances separate. That will not work for your taxes. You still have to file together.
Well,
Right.
there's another filing. There's a status that you can
Right.
pick, which is married filing separately,
Okay.
but it's detrimental. I mean, they cut everything in half for married filing jointly. It's not realistic
Okay.
status to pick. And so for most individuals that have gotten married over the past year, married filing jointly is the best thing to do.
Okay, great. Well, that's great advice for
Yeah.
newly married couples.
Also, keep in mind something particular to this region is that if you marry a non-resident alien, at the end of the year you will have to include that person in your tax return,
Okay.
and their earnings from Mexico would potentially be subject to
okay.
income as
So
well.
that's very important as well. So if you're marrying somebody that's a non-resident.
That is a non-resident alien.
Okay. Okay. Excellent. One of the other questions here is, what do we have to pay taxes on Social Security benefits for those who have newly retired and they're getting those Social Security benefits?
That's a really interesting question, and my dad was actually asking me about that because he recently filed for retirement. And the answer is normally yes, but the amount of Social Security that's subject to the tax is different. So what happens is that the IRS tells you that you need to look at how much income you earn as a whole, and there's 2 levels. So if you're in level 1, which is, I remember correctly, I think it's $40,000 for a single individual, only 50% of your Social Security benefits are subject to tax. And if you're above that threshold, then you have to pay tax on 85% of your Social Security.
Now, does that also apply for people who are receiving unemployment benefits?
It includes all of your income.
Okay.
Mm-hmm.
Okay. Now, are life insurance proceeds received before death taxable on your returns?
It's going to depend. So usually life insurance proceeds, when you receive them after that person has passed away, they're non-taxable. However, generally speaking, if you receive beforehand, it is taxable unless you meet certain requirements. And that's if the person that is receiving the actual life insurance proceeds, if they're chronically ill or terminally ill. And that has to be determined by a physician. If you receive the actual payments because you're one of those 2 things, then it could still be non-taxable.
Okay. Well, I'm going to take just a real quick break and remind everyone that we have a panel of CPAs that are here, and they are ready to take your questions. So again, they look a little lonely over there. They've had some questions, and there's a couple on the phone, but make sure you give them a call, 881-0013. They are here to help you today. Again, that's 881-0013. They are waiting. They just can't wait to answer your questions about all of your deductions. Okay. Now, we're going into rates and brackets, which for me is beyond my very limited tax knowledge. So you guys are going to have to walk us through this. Now, let's talk about the difference between the marginal tax rate and an effective rate.
Well, I mean, as you know, maybe.
Well, let's just assume
the taxables or the tax brackets, we have a progressive tax rate, and that's how we call. So we start like with the 10%, then 12% now, and then 15%. But like if you get to a certain amount of money or taxable income, and you get like into the 12% or 15% or 28% bracket, that doesn't mean that you are going to pay tax, on 28% tax on the whole amount. You pay progressively. You pay 10% like on the first $10,000, then you pay 12% on the following $25,000, and so forth. So the last bracket that you fall into, depending on your taxable amount of your income, that's your marginal tax rate. But the average of what you paid in the total as a whole, that's your effective tax rate. I don't know if that's kind of confusing.
No, okay.
Yeah, and it's important to know because marginally, that's what you're going to pay for every dollar you earn in addition to what you've already earned.
Okay.
And so you kind of need to know that rate. And then your effective one is like Ruth mentioned, it's your average. and that usually falls well below your marginal rate. Well, it is
Yes.
because of the way the tax structure is set up. So sometimes you get scared when you hear your marginal rate is 25%, but your effective rate, what you're really paying, is going to be well below that amount.
Okay, and going back to one of the questions or one of the things that we were just talking about married filing jointly or separately, there are actually different income thresholds for each of those. Can we talk about that for just a quick second?
Yeah, so probably the most beneficial status to pick in terms of the rate would be married filing jointly.
Okay.
And it's on average, what is going to be double the married filing separate status. So that means I don't have the actual thresholds in front of me, but you could be paying in a much lower tax bracket if your family or you as a couple earn $75,000, your marginal rate's going to be less than if you're to file married filing separately or single. Their marginal rate's going to be much higher. So the threshold is almost double for married filing jointly taxpayers.
Yeah, and some things to consider is if you're a qualifying widower, that means if your spouse passes away, you can still file married filing jointly for the following 2 years after your spouse's date of death, as long as you remain unmarried. So you can take advantage of those beneficial tax rates.
Oh, okay.
On the individual side, there's another filing status, which is the head of household, and that normally is available for single parents, which is more beneficial than the individual filing status.
That's me.
Besides that, for example, when you file for married filing separate, there are certain credits that they don't give to you as a kind of a penalty for filing married filing separate.
Okay.
So you need to be very careful. Why do you want to file that way?
Get along, file together. It's the best advice.
Is the best advice. Sometimes I have seen situations in which, for example, you get married and then your new husband has a big IRS penalty or tax liability from prior years.
Okay.
Since you are married now and you are filing together, then the amount of the refund that you are going to have together is going to be taken to pay for that tax penalty or tax liability that he already has. So in those cases, it's better to file filing separate, because then he deals with his own issues with IRS and you deal with yours.
That would be probably one of the exceptions.
One of the few exceptions that I have seen.
Or for some reason that his or yours was going to be garnished for some reason. So, okay, that makes sense. Now, this kind of goes into a little bit of business. So I'm filing as single, and I made a net profit of only $5,000 this year working as a sole proprietor. Do I have to file a Form 1040?
The answer is yes. So the general rule is that if your taxable income is less than the standard deduction, 90% of the time you don't have to worry about filing a tax return. So if you are working for a company, if you're an employee and you're part-time, you were only employed for part of the year, and your earnings don't meet that standard deduction amount of $12,000 for 24 if you're married, then you're basically exempt from filing a tax return. However, if you are self-employed, you are subject to what is known as the self-employment tax. And what that means is that you have to pay your own Social Security and your own Medicare taxes. So regardless of whether your taxable business income is, you would still have to file, because you have to pay your portion of Social Security taxes.
Okay. It makes sense, absolutely. Now, can I still deduct my charitable contributions this year?
Yes, so very little has changed with charitable deductions. One thing you have to realize is, again, it's an itemized deduction, so the aggregate along with other itemized deductions you might take have to be above the standard deduction in order for you to see a benefit. The one thing that has changed with charitable deductions in the new Trump law is that it used to be limited to 50% of AGI, which is your adjusted gross income. Think of it as your taxable income for purposes of what we're talking about here. Now it's limited to only 60%. So if you're a philanthropist, if you're given a lot, you can probably take more this year than you could in prior years. But most people aren't going to see that change. For most people, charitable contributions haven't changed much, other than is it going to be beneficial to take that over the standard deduction?
Especially people probably living in El Paso that aren't in that really high, tax or income bracket. They're not going to be donating half of their income.
Going back to the standard deduction, if you're in a married couple basically your charitable contribution would have to be in the realm of the $24,000 for it to make sense for you to deduct it.
Okay.
Right.
So answer is it's deductible, but probably not worth it not to go ahead and go through that itemized list.
I mean, I think if it makes a little bit more sense for a business to do it, or for someone that is self-employed and has generated taxable income, because then in that way they could use that to offset their business income.
So that's actually important. So if you're getting paid from an established business, and that's really going to you're just going to use your standard deductions. But if you're a business, if you own your own business, or you're filing, like that you would need to use that as to file your deductions.
Right. Basically, if your income is going to be significantly higher than the $24,000 standard deduction, or $12,000 if you're single, then you would have to start looking at your itemized deductions. And certainly, charitable contributions would be a good way to start.
And it's a good thing you mentioned charitable contributions, because all these tax law changes that we've talked about with itemized deductions, there's really nothing we can do about it. I mean, you're limited to $10,000 for your taxes, and that's all your taxes. That includes state income taxes, sales tax, real estate tax. You could just take $10,000. There's really nothing you can do about that. But with charitable contributions, there are ways that you can maybe donate more in one year and less in another. You can shift it where maybe you can push your itemized deduction total above that threshold and get a benefit for it. So you can play around with your charitable contributions and maybe save some money that way. It's one of the things that is available for taxpayers to adjust every year and maybe save some money by messing with the timing on when you make those contributions.
Okay. Yeah. It's important to know.
And now for those nonprofits out there that are soliciting donations from donors, it's important for them to understand what different kinds of donations are deductible.
Okay.
Normally, cash deductions are the ones that can be deductible up to 60% starting in 2018. And there's also in-kind deductions. So, for example, somebody that wants to donate a house, somebody that wants to donate a piece of land, somebody that wants to donate a vehicle or a piece of equipment, in-kind donations of that nature are normally deductible only through 30% of your taxable income. So they're somewhat limited compared to cash donations. A question that I get a lot is sometimes nonprofit companies will solicit services from professionals, from contractors, and they will ask to get an in-kind service, which is a great way to contribute to nonprofit organizations. However, unfortunately, in-kind services provided to a nonprofit organization are not deductible for tax purposes. So there's a really important distinction right there to know. However, if you're a professional, if you're providing your time, even though you're not getting a deduction for donating your time, if you have expenses that are tied to that activity, for example, mileage, or if you're traveling to, maybe you're traveling to help victims of a hurricane or something like that for a nonprofit organization, you can deduct those expenses as part of your general charitable deduction.
I think that's important to note because El Paso this year has seen an extreme rise in philanthropy, people raising money for certain organizations, and a lot of people have gone out of their way to collect things and then hand them over to the nonprofit. But if you're not working directly with the nonprofit on those donations, it could have serious tax implications, correct? For, say, for instance, I'm going to have a Amazon book drive, and I'm going to collect it all, but then I'm going to hand it over to an organization. They still are taxable on that, correct?
Right. Well, with the advent of Facebook right now, what we see is that a lot of people are kind of like collecting these, making these donations from peers and showing that as long as you can show that money is not staying with you, then you're fine.
Okay.
But if you don't have records of that nature, then you could potentially be subject to some kind of tax consequence. However, you can always say that this is a gift, and everybody is, there's a gift limitation of $14,000.
Okay.
So if there's one particular person that's giving you money, as long as that gift from them is less than $14,000 for a year, then it wouldn't have a tax consequence.
And that's $14,000 total coming in?
No, from each individual person.
Oh, okay. So that's also good to know. All right. Now, say for instance I had a life insurance payout after a death. My husband or wife passed away. Is the money that I received deductible on my taxes, or taxable, excuse me?
It's not included in your taxable income, especially if it happened after death. There are certain exceptions, such as you didn't pay you paid in more in premiums than you got out of it. Things that hardly ever happen. So for the most part, most people are okay with not claiming that as income on their tax return for life insurance proceeds after death. Yeah.
Right. Unfortunately, also, if you're a business owner and you are paying a premium for yourself, in case of a life insurance, that premium is non-deductible as well.
Yeah, non-deductible.
Okay. Now, what's the new, I think, Telo, you can kind of answer this, the new qualified business income deduction?
Okay. Well, I can explain
Maybe.
here in really general terms what it
Okay.
is, but I think Adrian is a real expert in this, and
okay.
Ruth as well. So one of the biggest changes this year for corporations is that the tax rate is going to be now a flat 21% for a corporation. Now, corporations are separate entities from individuals. Corporations pay their own taxes. However, if you are an owner of a corporation and you take money away from it, that's considered a taxable dividend. So that used to be, it really is a two-tier or double taxation system, right? However, if you are the owner of a, quote, small corporation or a limited liability company, those companies are considered pass-through entities. So what happens is that the tax made by these pass-through entities businesses is taxed at your individual income tax return, and they don't have a separate tax bracket. So for those C corporations, all of a sudden it became really advantageous to be in a C corporation because the tax went from 39% to 21%. And originally, a lot of business owners were starting saying, well, why don't we just switch to become a C corporation because we're going to get taxed at these advantageous rate. Well, the qualified business income deduction is a deduction that was created to level the field between corporations and smaller businesses. Now, if you're an owner of a limited liability company, if you're a sole practitioner, or if you're an owner of a so-called S corporation, what's going to happen is that the income from that business is going to flow through your tax return, and you're going to have to pick it up. However, now you're going to have a 20% deduction out of the income generated from that business, and it's meant to level the field between those big corporations that get the 21% rate and the so-called small businesses.
Yeah, this is probably the most complicated part of the new Tax Cut and Jobs Act. I can spend hours talking about this one deduction here, but in general terms, Teo has it right. What Congress had meant to do with this new 20% deduction is really help those taxpayers that actually have employees and that are small businesses, small-run businesses. And so, as a general rule, if you make under, for married filing jointly, $315,000 a year, or single individual, $157,500 a year, you can get 20% deduction on all qualified business income, which includes, as Teo mentioned, S corporation flow through, as long as it's a business activity, partnership income, also things that you have on your Schedule C, your home run businesses as well. You can add all those up. Then you can take a 20% deduction on that. Now, if you're above this threshold, it gets a lot more complicated. There are several things that
sounds pretty complicated to me right now. It sounds like I already probably need an actual CPA to walk me through this. So, if you own a business, the best thing, I'm sure, first rule of thumb, you need a financial expert to walk you through this to begin with. But it's a good starting point to at least explain that there have been pretty major changes with this tax law.
Exactly, and one of the things I would ask my CPA as well would be, can you do a cost-benefit analysis of staying a C corporation if you're a C corporation, or staying an S or partnership if you're an S corporation or partnership? Do a cost-benefit analysis. Help me determine what's best for me as an individual. Now remember, this 21% corporate tax doesn't go away. A lot of the individual changes that we're talking about today, they do go away after 2026. So
that was a big question of mine because I know some of them expire after a certain amount of time. This one is a permanent, until if foreseeable future, until the tax laws change.
The corporate tax rate, yes, that is permanent. Yes.
Okay. Excellent. Now, going back into some business things, say, for instance, you have like equipment expenses that you purchase for your business. Are those are those? Can you write those expenses off?
Most of the time when you purchase equipment, we call it what it's called that it needs to be capitalized. That means that we don't expense it like if we purchase office supplies or if we go to Sam's and purchase, cleaning supplies or stuff like that, that you use every day. When you purchase equipment, we call it that it's capitalized and it needs to go into your fixed assets. Obviously, we take depreciation and we expense it or we write it off over a certain period of time, depending on the type of the equipment, because supposedly it's going to help us to generate income through a larger period of time. That's something that you purchase every day. So that's why you expense it over a period of time. But this year with the depreciation changes, also we had a bonus depreciation that we can take instead of 50%, 100%. So if we purchase, for example, machinery that costs us $100,000 or stuff like that, we can depreciate it 100%, obviously depending on certain rules and limitations. But basically, that's what changed this year.
Yeah, for most businesses, they're going to get a write-off for most tangible assets. When I mean tangible assets, is standalone, non-real estate type assets. They're going to be able to take more than likely 100% write-off, either through bonus depreciation. There's this Section 179 deduction that they can also utilize. So it's very advantageous to make sure to ask your CPA about these issues, because you could do a lot of tax planning before the year end to buy a piece of equipment, finance it, and maybe reduce your taxes for the current year on that. So,
now, what are the changes for net operating losses incurred from a business this year?
Okay, so there have been a lot of changes. One of the main changes with NOLs is that you can no longer carry back NOLs, whether you're an individual or a corporation.
Can you explain a little bit? I'm still kind of fussy as to how the carryback works.
So usually an NOL, it's a net operating loss. So if you had a net operating loss in your individual tax return, you could have carried it back. What that means is you could have amended a your prior 2 years tax returns and got a refund from those by carrying that loss back to those 2 years. Now that's no longer available. You can only carry forward, but you can carry forward indefinitely.
Okay, excellent. Now, one little question before we go to a quick break. How long should we, as individuals or corporations, businesses, hold on to those tax returns and documents?
Most of the time you have to wait at least 3 years, because the IRS is back, is working still on 3 years, behind us. So you have to keep all of your documents for 3 years at least. Okay. But with other things, you have to keep at least 6 years, 7 years, or if there are very important documents like contracts or like your purchase of your house, the closings and stuff like that, like very life insurance contracts and stuff like that, you have to keep them indefinitely.
Okay, well, that's good to know. So again, I thank you guys all for coming in here to watch our show today. We would like to again thank the El Paso chapter of the TSCPA for being our panelists and our phone bankers today. So we would like to go ahead and just remind you a little bit about what the TSCPA does here in our community. Welcome back to to CPAs on Call, Tax Time. I just want to again thank our sponsors today. We are indebted to them. We wouldn't be able to have our program here and answer these questions without them. So once again, let's go ahead and thank our sponsors.
Good afternoon. Thank you for watching Tax Time. My name is Martha Piekarski. I'm the chapter director for the Texas Society of CPAs, and I am accompanied by my friend Roy. Roy, please introduce yourself.
Yes, hi. My name is Roy Padilla. I work for SPNG as an audit senior, and I'm also a member of the El Paso chapter of the Texas Society of Certified Public Accountants.
We're so glad to have you volunteering with these other professionals today. Could you tell us a little bit about what kind of questions you're getting?
Yes, actually, we've had a lot of questions about what the new changes are on the 2018 tax laws, as well as what qualifies as a deductible expense when it comes to your health insurance, and what happened to the personal exemptions, and why did the standard deduction double. So we're really digging deep.
That's interesting. Could you give us a little more information? I know that this is kind of confusing this year. And it's good that El Pasoans are able to count on professionals like you.
Oh yes, as a chapter, we think it's really important to help out our community and do services like this, so that we can let everybody know in El Paso County and surrounding areas that we are a very valuable resource, and we're here to help.
Well, Roy, I really want to thank you today for helping us out, and I guess we'll go back to our panel.
Welcome back. Thank you again for answering those questions. We do have a few questions coming in from our panel today. I want to remind you again, we are streaming on Facebook Live. We will be taking any questions that you have there and hopefully being able to answer them with our panel here. So one of the first questions we have, it's pretty simple, hopefully. Our viewers want to know if they would like to reach you personally, how they might reach you. So Ruth, if you'd like to go ahead and start us off.
Well, you can call the Texas Society of CPAs to get our information. We also have our each of our phone numbers that you guys can contact us. My office is called Elizondo and International, and it's listed on the internet as elizondointl.com.
Okay.
And my phone number at the office is 915-270-9226.
Adrian?
All right. Well, I currently work for Lauterbach Borshaw and Company. Our website, and it's probably the most beneficial place to go to, especially in today's technology world, would be www.lb-cpa.com. My phone number, if you want to get in contact with me, is area code 915-544-6950.
Okay, and same way with us, with SBNG. We have our website, www.sbngcpa.com. We have plenty of client testimonies in there, and we have information about the different services that we specialize in, as well as profiles from the membership for management team. Our phone number is 544-6770, and you can also reach out to us on social media.
And if I heard correctly, Roy, who is just speaking, he also is with your company. Is that
right,
correct?
Right,
Okay.
Roy and I work together.
Great, so they can reach both
yeah.
you and Roy at the same time. Okay, excellent. Now, we have another question as well from our viewers. I'm going to go ahead and read this off. So the taxpayer's retired. He's funding a Roth IRA with pension monies. Is this allowed? He was told that it was not, but he said that he had been funding it with unearned income in the previous years. What steps would he need to do to fix it if necessary?
Well, there were, I don't know if this was the questioning he had, but there
Okay.
used to be things called conversions for IRAs where you can convert 401ks, traditional IRAs to Roth IRAs. That's no longer available for taxpayers starting in 2018. So in order to fix it, I don't know, call his actual IRA administrator and ask him the steps he needs to do to fix that problem. But that might be where he's coming from, is he can no longer do those type of conversions. So.
Okay, so he would probably need to speak with the administrator for his IRA and no longer fund his Roth IRA with the pension. You'd have to find a different way to fund that. is that?
Well, it's just generally you fund a Roth IRA with income where you already pay taxes on it.
Okay.
But if it's unearned income, I mean, it's kind of iffy there. I mean,
Okay.
Yeah, my question is, why is he funding a Roth IRA with pre-tax dollars?
exactly.
Right, he could be funding an IRA account and have no tax consequence.
Okay.
Right.
So he definitely needs to reach out to somebody, but it's a good one. Okay. Well, again, want to remind everyone we are streaming on Facebook Live. We'll take more questions. As you saw, we were able to answer a couple of those while we were waiting. I wanted to ask Ruth. Ruth, you specialize in international, a little bit of international taxes. So there was a question that I wanted to just specifically ask you. It's more, I think people here in this community may need to know international tax laws a little bit more than, say, if you lived in Omaha or something of that nature. So can you just go ahead and give us an overview of the main tax implications for taxpayers that have businesses in Mexico?
Yeah, sure. For example, let's say that you decide to go and open a business in Juarez, per se. And you need to know that you are going to have to pay taxes over there because you are in another country. And you are going to have to register with the Mexican government over there, which is the SAT, and which is kind of the IRS for here for the United States. And you are going to have to pay taxes. Now, it depends if you are a sole proprietorship or if you are a corporation. There are different implications, and you have to come and report here in your U.S. income tax. As U.S. citizens or residents, we are required to pay taxes of all of our overall world income. Like if you have an interest account or a checking or savings account in China, and you get interest over there, you have to report it in your income tax. It's the same as a business here in Mexico. But it depends if you file over there as a sole proprietorship or if you have ownership in a corporation. There are different filing requirements that you have to do here. Now, you don't pay taxes twice. If you have to pay taxes in Mexico, then you have a credit over here. You have to report the income, but you get a credit for the taxes that you paid over there. Okay. So don't worry about that. But there are filing requirements that you have to follow depending on how you are doing business in Mexico. And if you have checking accounts or savings accounts that you have a signature authority, that means that you take the money out. Then you also have to come over here and report those checking accounts. Those are called informative forms. You don't have to do anything. You don't have to pay taxes, but you have to tell the government that you have those accounts. If you in an aggregate, if you accumulate more than $10,000 in a single day, that means that someone deposited in your business $10,000 in your checking account over there in Mexico, in Vancomer, for example, okay. and then you take the money out. It doesn't matter. I mean, you already had $10,000 in one single day, so you have to report it in your income tax here in the United States.
Are there tax professionals in Mexico that do this, or are there people here in the United States like yourself? Would you do taxes for both countries? Is that, or do you refer for the Mexico taxes and then you kind of?
Yeah, I mean, generally what I do, specifically myself, I always say that if I can't try to learn everything, I won't be able to learn the whole thing. Right. So I specialize in taxes here. So I work a lot with Mexican accountants. Okay. So for example, if someone wants to go, if you want to go and open a business in Juarez, I will recommend you someone in Mexico that I work with, so I can relate to and help you out to do the Mexican side of the business. But I'll tell you how to report it here in the United States.
So really you're working with two tax professionals from their respective countries, and they're working together to make sure that you're taken care of. Okay, excellent. All right, let's go back to, let's see here. We talked a little bit about businesses. Let's go ahead and talk about back to some Schedule C information. So what expenses can I deduct if I'm an independent contractor?
Normally all the expenses that are related to conducting a business. For example, mileage per se would be a really big one. If you buy a vehicle and you use it for your business, you can certainly deduct a portion of that, a passenger vehicle. However, there are some limitations, and I believe the limitation for 2019 2018 and going forward is the first $8,000 of the cost of a vehicle. Now, if you use this vehicle also for your personal life and also for your business, then you can only deduct a portion of the amount that you use it for your business. Okay. Meals and entertainment, you can deduct. You can no longer deduct any entertainment expenses, even if they're related to your business. And meals, you can only deduct half of them. Any other business expense, for example, if you have an employee that helps you, if you contract other individuals to help you in your contracted businesses, if you have interest that's related to your business, you can also deduct this.
Okay.
Yeah, a good rule of thumb, if it's directly related to your business and it's not optional to conduct your business, then it's deductible as a business expense. You mentioned this is an independent contractor. Remember we talked about the qualified business income deduction? If he makes under $315,000 or $157,000 if he's a single filer, then they can also get the 20% qualified business income deduction, which is based on his net income. You take 20% of that, and you get that deduction as well. So,
okay, excellent. Again, I want to remind the audience, if you have any tax questions, our panel is here. I see some of them that really want to talk to you. They've been begging, they've been waving at me. 881-0013. Again, that's 881-0013. They want to help you answer any of those tax questions. Again, the filing season, it's already open, and the IRS is open at least for the next 3 weeks, so let's get those income tax returns figured out here in the next couple weeks. So now, if someone sold their home in the last year and they sold it for more than what they paid for it, do they have to report that change on their tax refunds, on their tax returns?
Generally, you have to report that you sold your house or your home, but you have a deduction and not pay taxes if you sold it for a gain.
Okay.
I mean, that's a general rule. Obviously, there's always exceptions. Yeah.
Okay. Still have to report it, but there'll probably be, you'll be good. Okay.
Yes. So you have to be in the residence for at least 2 years of the last 5 years. And then there's a limit as to how much gain you can exclude, and the limit is $250 if you're single, or $500,000 if you are married filing young.
And that's the gain, not the sale of the house.
Okay.
Because
so
sometimes people get confused.
Okay.
I mean, if your house cost $250,000 and you sell it for $700,000, then the difference is your gain.
Okay.
Right. Now, if you're a person that moves often because of your job requirements, you might be in a situation in which you sold your second house within this same time frame.
The two-year period.
Yeah, the 2-year period. So you could still be subject to an exception, an exclusion, which is the tax term, but you would probably have to talk to your CPA to figure out how much of it you can still exclude from your taxes.
Okay. Well, moving on as far as income that's coming in, say, for instance, my mother passed away in the last year. I inherited money from her. Is that taxable? Do I have to pay taxes on that inheritance?
Well, let me ask you a question. Does your mother has more than $11 million worth of an estate?
She did not. It was nowhere near that.
Okay.
Then don't worry about it.
Don't worry about it.
I'm just one of those Central El Paso living people, so.
I think there's a general misunderstanding about gifts. You had mentioned, do I need to pay tax on it? Well, when you receive a gift, if it's a true gift, you have no tax responsibility. It's the person giving the gift that might have a tax responsibility. It's called a gift or estate tax, and they're linked. Whether you give the gift or that person passes away and leaves it in their estate to somebody else, they could be on the hook for what's called gift or estate tax, and it's a high percentage. The good thing is, as Tail mentioned, there is an exemption, and that exemption bumped up to $11 million. So if you don't have an estate or you haven't given gifts throughout your lifetime above that $11 million threshold, then you, as that giftor, does not have to pay the gift or estate tax.
Now, on that note, if my mother passed away in the last year and I'm the executor of her estate, I still have to file taxes on her behalf. Is that correct as well?
That's correct. And the IRS has a really nasty way to have us remember this. So it takes us 9 months to get into this life from the time we're conceived into our time of birth. When you pass away, the IRS gives you 9 months to file your last tax return. So that would be a 1040 less. I think is there a special name for that, or is it just a 1040?
Just a 1040.
Just a 1040.
It's just a 1040.
Right.
Mm-hmm.
And then if it goes into an estate, that estate also has to file a tax as well, for as long as the estate holds the asset, meaning the estate holds it without distributing out the assets.
Okay.
So
if there are things held up in the estate for longer, the estate also has to, okay.
Yeah, for the income it's incurred while it holds the assets.
Now, I've seen it set up where you're retired and you set up the estate. What are the tax, advantages do you have to setting up an estate versus your just individual taxes, say for instance on your home before you pass away?
Well, there's these things called living trusts.
Okay.
And one of the good things about having a living trust, in addition to having a will, is that you can avoid probate. So let's say you pass away, it doesn't have to go through the courts in order for your assets to be released to whoever you deem would be the inheritors, whoever gets that. So it's a very good gift that you can give the people that you love, the people that are inheriting your estate when you pass away, is to set up a living trust to avoid that probate.
So the living trust, although it helps your beneficiaries, it doesn't necessarily help you tax-wise.
No.
Okay. Good question to ask, though. Okay, excellent. So let's see here. If, say, for instance, we have a rental property, selling one of the rental properties to my son or a family member, are there tax problems with that sale to the family member?
Generally, no. But you have to be careful with sales to related parties, because if you sell it for a loss, it's going to be non-deductible. Now, the non-deductible loss portion, if that person that you sell it to then ends up selling it, they can take that as an exclusion from any gain that they do sell it for. But it is something that can bite you. If you sell it for a loss to a related party, it's non-deductible on your tax return. So,
okay. On that note, what's a wash sale? That terminology. What does that mean?
Well, generally, that's like when you are trading stock in the stock market, and you want to take advantage of certain company stock that it's like low or something, and then you sell it and you get a loss, and then you acquire it again very quickly, like within 30 or 60 days. Then that's what it's called a wash sale, because basically your intentions were not to sell it, but just to obtain a loss of the benefit, so they don't let you take the deduction of the loss.
Yeah, and usually with wash sales, people get involved with wash sales without even realizing it. So the way it's set up with the IRS is if you sell something that's substantially identical, stock or an investment, if you sell it and then you buy it again 30 days before you sold it or 30 days after, then the IRS considers it a wash sale, and that's the way they categorize it. And therefore, that loss is not going to be deductible. And I've had several clients go through this situation where they didn't know they were getting involved in a wash sale. They sold something to realize the loss to offset other gains, and then it comes back that it was a wash sale and it was no longer deductible, and then they're paying tax on that other capital gain that they did realize. So it's something that you have to be careful with. Sometimes that people get in trouble with here as well is that wash sales aren't on an account-by-account basis. It's you as a taxpayer. So if you sell something in one account and then buy substantially identical stock in another account, it might not be triggered by each individual broker or account, but you still have
Overall,
a wash sale.
It'll be okay. Now, as far as trading, one of the big things this year was the rise of Bitcoin. And some people are wondering, is Bitcoin taxable on your income tax?
Yes, it is. The IRS recently came out with a provision, a notice, a reg, specifying that any transactions that are settled in electronic currency are to be included as any other kind of transaction. So that's short and easy answer for that one.
Okay, so you still have to pay on your imaginary money.
Right, real taxes.
Okay, real taxes on your imaginary money. if you received a 1099 from your bank saying that they withheld income tax, how do you go about getting that money back?
Well, first of all, you need to make sure that you actually did get a money withheld.
Okay.
But I mean, if it's from a bank, and generally the 1099s wouldn't be like mistaken or have errors. But
Is there a reason why a bank would do a withholding?
There are several reasons that you can withhold from 1099s, especially, for example, if you're a non-resident. Okay. And if you have bank accounts here as a foreigner, then the bank is required to make withholdings on the income of your money, not on your own money, but on the interest that is generating. Okay. Most of the time you don't. You have to file certain forms like the W-8BEN to say that you are the beneficiary of a tax treaty and stuff like that. I mean, then you get into a lot of international deals, but to avoid the withholding. But if you get withholding, I mean, generally just report it on your income tax, like what you do with your W-2.
Okay.
If you actually did get withheld.
Okay, excellent. Again, I want to remind our audience that we have our phone bank here. They seem pretty quiet, and I haven't given them any coffee yet today, so I want to make sure that you guys keep them awake. If you can go ahead and give them a call, 881-0013, 881-0013. They really want to answer all those questions that you might have. They are CPAs, and they are very qualified to answer those questions, and if they don't know the answer, they're going to figure it out. So let's get back to gifts, some gifts on our tax return. Say, for instance, I gave my son $500 a month to help with his living expenses. He's in college. How would I get that income back on my taxes?
Unfortunately, you cannot deduct this expense because it is considered a gift. But the good news is that in this particular example, you would also not have to pay the gift tax because you would not meet the annual $15,000 limitation. And actually, as long as you didn't exceed that threshold every year, you can make multiple gifts to your children, to your relatives, as long as the value of that gift does not exceed the $15,000 every year.
Yeah, and if you remember, we talked about the lifetime exemption of $11 million. It doesn't even go against that because you have this threshold of $15,000. If it's under that, it's non-reportable. Therefore, it doesn't even go against the $11 million threshold. So you can still give $11 million away and be tax-free.
There is no way I will ever be giving my son $11 million. I can sorry, honey, if you're watching. Sorry. Now, I have a question here. What is an AMT tax? Can you explain what those initials are and break that down for us?
That has been a boo-boo for accountants for a long time.
In short words, and my easy definition of the AMT tax, obviously the letters stand for alternative minimum tax.
Okay.
And basically what I say is, like, when you have to pay taxes and the government feels that you didn't pay enough, then the AMT comes in and gives you an additional tax, basically.
Oh, okay.
It's an additional tax that you have to pay on top of your income tax. And it's calculated. I mean, it has its calculations and everything. But sometimes you get to a point, like, for example, let's say that you want to lower your income tax, your general income tax, and you are triggering the alternative minimum tax, the AMT, and you try to lower it. Let's say that you find another $1,000 on charitable deductions to increase your itemized. Your income tax decreases, but your AMT increases. So that's why I'm saying, I mean, it's like a kind of what the government puts in to say, okay, you are not paying enough, I'm going to give you a little bit more.
How would they determine to trigger that?
Oh, so alternative minimum tax, it's another tax regime. So really, as tax preparers, we have to do almost another tax return because there's difference between AMT and regular taxes. So we calculate alternative minimum income as well, taxable income, and then they apply a flat 20% at the individual level. And if that is greater than your regular tax, what they're saying is you use too many deductions. Therefore, you didn't pay enough tax, just like we said. So we're going to make you pay the higher of the two. And so, first of all, you have to calculate it, and then you have to apply the 20%. And if it's greater than your regular tax, then you're subject to greater tax than what your tax return says. So The good thing is for corporations, the alternative minimum tax with the new Trump laws is completely abolished, so there's no more AMT for corporations.
For corporations.
Yeah.
So it does appear that the Trump tax laws, again, which we've heard widely about, they really do benefit a lot of these corporations for some of those extra taxes that they were getting on top of their regular taxes.
It benefits a lot of the businesses.
Okay. Businesses, small businesses. Well, I have a question from one of our Facebook viewers. Thank you so much. So this question comes in, the taxpayer receives Social Security benefits and health care credit. The question is, does he have to file a tax return because he receives the health care credit?
I would suggest for him to do it, because since he's going to be receiving a 1095A for the credit, then he needs to report in his income tax that he has enough income to get the credit. And not to pay extra tax.
Right, and normally the health credit are benefit directly when you contract your health insurance. So if you go through the health exchange market and you qualify for this credit, it would be taken as a deduction from your monthly health insurance premiums, but nonetheless you would receive a 1095 like Ruth is mentioning, and that will disclose the credit that you received.
So I know one of the things I've heard is, well, I'm probably going to get a refund, or I'm not getting any tax return, so do I even need to file my taxes for these lower income, perhaps people that maybe are receiving Social Security benefits or SSI benefits? Rule of thumb?
So the rule of thumb, if it's just Social Security, you don't have to file.
Okay.
If that's the only thing they're receiving. And now there are general guidelines and markers on when you have to file. If you have earned income, that's all you have. If you make less than $12,000, which is the same as the standard deduction for a single file taxpayer, then you don't have to file. If you have unearned income, it gets a little bit tricky. I think it's $1,150. If you make above that, then you have to file. And you have the combination of the both, and then there are other thresholds as well. But usually that $12,000 marker, if you have just earned income W-2, you make less than that, you probably don't have to file. Now, should you file? If you had withholding, then if you want to get that back, then you probably should file.
Okay. But so if you're getting the health benefit along with your Social Security, definitely go ahead and file. This is our recommendation to our Facebook viewers. So yes, go ahead and file, please. Should be able to do that hopefully online or in a pretty simple way with those credits. So let's see here. Now let's go into a little bit of nonprofits. I know, Theo, that's a little bit of your background. Nonprofit organizations, they still have to file tax returns. Can you go ahead and give us a little bit of background on that? There are differences in the deadlines. Is that correct?
That's correct.
Okay.
Yes. So first of all, if you're a nonprofit organization, the first step is to try to get your exemption recognized by the IRS. Now, there are two different ways of doing it. One way is to file Form 1023, and that is if you want to become a 501c3, which is your blanket exempt organization. This form is a little bit more lengthy than the other form. It has a lot of details. Basically, the IRS wants to know what your mission is. It wants to want you to have a formal incorporation document, which means you need to be a legally established corporation. Your mission statement needs to be included in this document as well. In addition, when you file this request for exempt status, you need to include a narrative as to why you want to be a nonprofit, how do you plan to raise funds, and how do you plan to use your funds. So essentially what they want to see is they want to see a budget for the next 3 years.
And that's when you're filing for your exempt
Yes, that's when
status.
you're filing for your exemption. Okay. And with the IRS, in my experience, it normally takes them about 6 months to come back with you and give you that exemption letter. Now, the exemption letter will specify what type of nonprofit organization you are from the IRS eyes, and if you're related to another nonprofit organization, or if you are a private nonprofit organization that is funded by a group of private individuals, then the IRS will assign that to you in your tax exemption letter.
And there's a lot of different things too, like say for instance you have your nonprofit, but you may have several DBAs umbrellaed under that.
Right. So if you are a nonprofit organization, you can certainly have an LLC, or you can certainly have a separate corporation that is controlled by the nonprofit organization because it has the same board members, right?
Okay.
The IRS normally will have you apply for a group tax exemption letter in which you have all the nonprofits under your umbrella, and all of them are recognized individually. The subsidiaries might have their own tax-exempt status.
Okay.
So you might have a nonprofit for animals, and then you might have a foundation that supports that nonprofit.
Okay.
And they would both potentially have to file separate tax returns. Now, if the nonprofit has an LLC, and it's a sole member LLC, meaning that the nonprofit is the only owner of this other limited liability corporation, then the LLC is what is referred to as a disregarded entity, meaning that they file a combined tax return. And you're right, the deadlines are different. So nonprofits normally have fiscal year ends, and normally most of them fall depending on what their grant requirements are. So if a nonprofit works with a lot of state grants, normally their year end will end in the same time as the state year ends, which is normally September or October, or I'm sorry, September or August. A lot of nonprofits also have a calendar year end, and a lot of them have a June year end. And the filing requirement is that you need to file Form 990 5 months after the end of the fiscal year for the nonprofit. So for those nonprofits that have a fiscal year ending in December, their 990s will be due on May 15th.
Now, nonprofits actually are one of the unique tax entities because they're one of the few that you can actually search their tax refunds easily online. Can you guys explain a little bit about that? Because I know that there's some people that are wondering, oh, well, I would like to give charitable donations to some, but they're not sure how they're structured, and they want to look a little bit deeper into that.
There's certainly a lot of ways to do this. The easiest way is to request that nonprofit organization's 990. Most nonprofit organizations make their 990 forms available online in their websites, or they normally are available upon request, so you can literally just pick up the phone and ask to see the latest 990. There's also a really well-known service in the internet called GuideStar, in which you can subscribe, and you can look up pretty much any 990, and they're pretty close up to date. Normally you can see the latest 990 or the one that was filed 2 years ago. By looking at the 990, the type of nonprofit comes up in the first page of the return. So it's like the third line in there, and it will tell you what kind of nonprofit you are.
You can get the basic on the GuideStar for free. I think you can pay a little bit more if you're interested. I've had to look up some before, so it's a really good thing if anybody is looking to do a charitable donation to one of those nonprofits and you're wondering how their money is flowing in and out. It's a really good...
Right. And a rule of thumb in the nonprofit industry is to look at the breakdown of their expenses. Nonprofits are required to report their expenses by function, which means that they are required to tell you how much expenses are expended in the nonprofit's mission and how many expenses are devoted to administrative functions. So you can compare one nonprofit organization to another nonprofit organization by looking at their respective tax returns and figure out which one of those organizations spends more money in admin and which one spends more money in the actual program.
This is good to know. Again, I want to remind our audience that you can call in to our phone bank here. It is 881-0013, 881-0013. Yay, thank you guys. And again, we also have our Facebook Live questions. Victor's over here. He's ready and to go ahead and hand in those questions to me. So I'd love to take some more caller questions here in the next few minutes. So again, thank you guys. Hopefully you can give us a call. All right. Now, we're going to go over to some extra questions that we had here on our page. Let's talk about a kiddie tax. That's something that we've heard in the past. Is the kiddie tax still a thing? Let's go ahead and go over that for us.
Yeah, so the kiddie tax is still implemented. If you have, if you're a child or a kid that has between the ages of 19 and 23, and you have income above $2,100, investment type income, unearned income, then you are subject to the kiddie tax. Now, in prior years, the kiddie tax was based on the parents' rate. Now, under the new Trump law, it's based on actual trust and estate tax rates. Now, the thresholds on that, meaning the width on when you're taxed at lower rates, is a lot smaller. So they could hit that top percentage pretty quickly. So it's probably going to be a little bit more expensive for kitty taxpayers on that unearned income. And what they're trying to do with the kitty tax is try to avoid parents in high income tax brackets gifting accounts to their children, and then their children paying in lower tax brackets. So this kind of fixes that loophole.
I see. Okay. Now, I have perhaps a teenage son or daughter who worked over the summer, maybe at a restaurant or Wet n Wild or something of that nature, got a W-2 for $2,300. Does my child have to file taxes on that $2,300 W-2?
Well, I mean, as we already discussed, I mean, if they earned not enough of their standard deduction, which is for a single person $6,000, they don't have to file a tax return, but they can file their tax return to get their withholding back if they have withholding.
And would you still be able to claim that child on your taxes as a parent? Right?
You can still claim him as a dependent.
Okay, which is important because I think there's a lot of parents that are, got to file that for their FAFSA returns and everything coming up. So, now, if I was not married I think this goes back to some of the filing statuses, not married for all of 2018, what filing status would I choose? Single.
Yeah, so in that case...
Single. I'm getting this down, guys. I'm getting it down.
If you have a
child. So that's really the difference is if you have a child, you can file as head of household.
Or if you're supporting your parents. If your mom lives with you and you support her, she can be your dependent too, and you can still be head of household.
Okay. So, and that's if your parents are not making any income or underneath that tax threshold? Is that how you can claim them as a
but they also need to live with you. That's also very important. And it could be another qualified relative as well.
Okay. I wish I would have known that.
So with divorces and marriages, the date you need to look at is December 31st of that tax year. So if you're married on that date, you got married during the year and you're married as of that date, then you can file married filing jointly or married filing separate.
The same falls for dependents. Say, for instance, if you have a child, correct?
Exactly. So if you have a child, I mean, if you're on the border of having a child the 1st of the year or the 31st of the previous year, hopefully you'll have them the 31st because then you'll get that extra child tax credit.
A little bit faster, at least. Yeah. You'll still get it, but just it depends if you have to wait a year or not. Okay. To some deductions here with businesses. Say, for instance, if we have a viewer that lives in El Paso but owns a business in Alamogordo or Carlsbad, and they've traveled for the past 2 years back and forth, is the mileage for that commuting expense for your business deductible?
The commuting mileage is not deductible, unfortunately. But sometimes what you can do is plan your trips. For example, if you go from your house in El Paso to your business or your office in Las Cruces, that commuting time or mileage is not going to be deductible. But from Las Cruces, let's say that you go to Alamogordo or you go to other areas of the state, and then you come back to Las Cruces, all of that is deductible. And then, obviously, from Las Cruces back to El Paso, that's not deductible again. So it's just a matter of planning your trips.
Okay.
Yeah, so normally everything that's outside of your daily commute would be considered a business expense or an additional commuting expense, and you normally can deduct mileage for that. But if it's between your house and your normal workplace, then the answer is no.
Yeah. And make sure you keep those travel logs. You should have one in your car if you have a business, because those are instrumental in defending yourself if you're ever audited with the IRS.
Okay.
Yeah.
Or with technology, I use apps.
Yeah.
There are apps for that now. So there's an app for everything. I know that there are a lot of people also here in town that were making extra income by owning homes and renting those homes out. Now, they have different jobs that aren't related necessarily to real estate, but that's their extra income. What costs can those people deduct if they have several rental homes but also have separate
I mean,
jobs?
Obviously, as we talk about, the definition of an expense is everything that is directly related to the making of the income.
Okay.
So everything that is directly related to the rental house is going to be deductible. However, if you have several rental homes and then you have your your job and you have other businesses, you have to be very careful in separating what those costs are specifically for that income, so you can take it. So you can take the deduction against the rental income.
Okay.
Yeah, and rental properties are special because let's say you have a home in Alamogordo or Cloudcroft, Ruidoso. Pretty sure some of our viewers have that. You could be in the situation where you stay in that rental home, and you got to be careful because if you stay in that rental home above 14 days a year, then you could taint the actual expenses of that rental home to be personal. So you might have to divide the utilities, the actual cost of insuring the property between personal and rental. If you stay below the 14-day threshold, you can consider it all rental activity, and you can take a deduction for it.
So on that note, what are the tax implications if you have, for instance, like a timeshare? Or are there different tax laws related to those types of homes?
Well, if it's a vacation home, I mean, it's personal.
Okay.
And so most of those are non-deductible unless they fall under Schedule A itemized deductions, such as a mortgage interest on a second home you can do it on. Property taxes, but again, you have that $10,000 threshold. If it's personal, you're going to have to look to Schedule A to see if you can take those deductions.
Okay.
Yeah.
Okay. Well, we have another question from our audience. We have a caller who still owes taxes from 2007, is currently disabled, not working. How long until the IRS stops trying to collect? Is the question.
Gosh, I mean, that's difficult because the IRS generally don't stop collecting unless you make an agreement with them to probably lower the liability. There are certain forms that you can file to show that you don't have any income or that you have a disability, that you are not generating income to pay for your taxes, and you come to an agreement with IRS to lower your liability. But that's the only way that you can stop, the IRS from trying to collect. But you have to come to agreements with them.
So avoiding those phone calls is not the way to go about it.
No.
And it's my understanding, I'm not an expert, but I think it's student loan debt and IRS are the only two things you can't get rid of with a bankruptcy, I believe. So
That's
those
correct.
things you'll have to deal with at some point or another,
And
even if your income unfortunately is not, disabled or you're not
with an IRS tax liability, normally if you are under $50,000, the IRS would be somewhat more lenient in accepting an installment plan. But what many viewers may not know is that as long as you owe the money, you would still accumulate interest, right? So you may be able to avoid some of the penalties. However, the interest will continue to be accrued like any other liability.
Same as student loans.
Same as student
I got
loans.
you. Okay. Which is, sorry caller, but thank you so much for sending us in that question. Again, if you have any other questions, make sure you go to our Facebook Live. You can ask questions there. Go ahead and give us a call, 881-0013, 881-0013. Our phone bank, there's a couple of them that are waiting for a call, so they'd like to hear from you. Okay, let's go ahead and go into a little bit more about like professional licenses. You guys are CPAs, and there are licenses, professional dues, you pay as an employee. Are those deductible in your taxes?
It depends. As everything with the IRS, if you have your own business, obviously that's going to be a business deduction. But for example, if you are an employee and you have to pay for your own memberships and dues and professional licenses, those used to be part of the unreimbursed job expenses or miscellaneous expenses on the itemized deductions, and they are no longer deductible.
Okay.
Yeah. I think this goes a long way into saying, Trump, the administration had wanted to simplify the code for most Americans, and I think they've done that. So the bad part about that is we're losing a lot of deductions, and one of them is if you're a W-2 employee, you can no longer take those deductions that you have for your job. There are some exceptions for educators as well. They still have the $250 deduction that they can take if they've incurred expenses to do their job. Principals, teachers, counselors, things like that.
So those are the few exceptions that profession Okay.
Right.
Yeah.
But with the good is the bad, I mean, you do have that higher
Standard deduction.
So
Yeah.
hopefully it'll just kind of all come out in the wash, ideally.
Yeah.
So.
And the flip side, many employers offer tuition reimbursement
Mm-hmm.
as a fringe benefit, and that remains untaxed
Yeah.
for this year. And I believe it's up to $5,000.
Up to $5,000 per year.
Right, per year.
Okay, excellent. I think we've already covered whether or not someone should use the itemizer standard. For the most part, it seems like this year, the standard deduction, unless you have a high threshold of other deductions, is just the way to go is the standard.
Correct.
Now, on that note, there are a lot of people that have home offices. They office out of their home. Are those deductible, or are there certain expenses occurred with the home office that are deductible?
Are deductible as part of your business.
Mm-hmm.
I mean, not if you work from home, like when you take work from the office and you're a W-2 employee, because that's part of your unreimbursed job expenses. But if you have a business and you have an office in your house, you can take a percentage out of the total expenses of your house for use as a business deduction.
Yeah, and you got to be careful there. The actual law is it has to be regular use of home and exclusive use of that portion of the home.
Mm-hmm.
So you can't have children. It has to be a separate area where you just work on that, and it also has to be the primary purpose where you do that job as well.
Okay.
So if you have an administrative office back in your office where you work, and you do administrative type work at home, then it's not going to count. It has to be exclusively done in the home as well. So,
Okay.
yeah.
So say, for instance, you're a real estate professional, you have your office, that's where you office out of, say, for instance, your home. But it can't be, it's also the kids' playroom kind of deal.
Right.
It has to be exclusively for
Exactly.
the use of your...
Or that you just sit in your dining room to work with a laptop. I mean,
Gotcha.
stuff like that.
Yeah, and there's also a safe harbor rule in which you can apply a dollar rate to each square foot that you use in your house
Okay.
for your home office.
Yeah, it's $5 and up to 300 square feet, so you can get a $1,500 deduction without having to do anything, as long as it's exclusive still.
So-
And yeah.
All right. Now, this coming year, say, for instance, we have someone that had a medical issue in 2018, and there are a lot of medical expenses, and you also are paying medical insurance for pets. Sorry, let's see. Let's do this. Is there medical expenses for pets? Can we deduct the pets' medical bills? Let me get to that. Sorry, that was a roundabout way of asking if I can deduct my cat's vet visits off of
That's
my...
pretty tricky, pretty clever.
Yeah, I was like, wait a second. I think that's if I do this and this and...
Unfortunately, no. The expenses have to be for humans, and it have to be for people within your household or any dependents.
For your dependents.
For your
Yes.
dependents, yeah.
Who says they aren't my dependents?
Your human dependent.
Okay. Now, if we have viewers that perhaps refinanced their home in 2018 and then they paid closing costs, are they able to deduct those closing costs off of their returns this year?
The loan origination fees or points, you can take a deduction for those in a refinance, but you usually have to amortize that over the life of the loan. And so you can do that as well. You got to be careful with refinancing, though, now. One of the changes that has happened is that you can take an interest deduction on your mortgaged property, but home equity loans,
Right.
those used to be deductible. The interest portion, they're no longer deductible unless you use that home equity line to build another portion of the house or to do a major remodel. So that's something that's changed. In prior years, you could do whatever you want with the money. This kind of falls in line with that. So if you refinance, make sure you refinance for the same amount that you have loaned out. If you refinance for more, it could taint the loan, and you might not be able to get a deduction for that. So, yeah.
Okay, that's important to know as well. Now, maybe perhaps we have some people out there who loaned a large amount of money to a friend this last year, and they know that they're not going to end up getting that money returned. Are they able to deduct that off of their return this year?
That's a complicated question, and normally the answer would be no, unless the taxpayer that is lending the money has other kinds of capital income. Now, what capital income is would be earnings from investments or earnings from selling property. So normally you can only deduct a write-off of a personal bad debt if you have those sources of income. And you're limited to the amount of capital gains that you have in that year.
So for most people, they're probably out of luck and out of a friend at the same time.
Probably.
We have another issue here. If you have a daycare service that you're running out of your home, and you know the rules for deducting a portion of your home business are fairly strict and exclusively used as a business, but say, for instance, you feel like you're using your whole home, even though you're only using a part for your daycare. What's the best method of going about this in your refunds and your returns?
So for daycares, I mean, we talked about home office use, and it is very stringent on that, but daycares are an exception with the IRS. What you can do with daycares, because, I mean, you're using your home while you're operating the daycare. However, at night, you're using it for other uses as well. Well, the IRS recognizes this, and they offer an option for daycares. What you can do as a daycare user is still take that home office, or since you're using most of your home, you can take a proportion of your actual home expenses, and then you have to allocate it based on the time that you spend using it as a daycare versus the time you have personal use of it. And so that exclusivity that we talked about prior for home office use, it doesn't really apply to daycares. They have to use this method. And so it's a bonus because they get to take something.
Okay. Now, if you have a credit card company that forgave a loan and you received a 1099-C, do you include this on your tax return this year?
Yes, you have to.
Okay.
Include it as other income.
Okay. And then you said that I'm seeing that there are exceptions for bankruptcy
or solvency.
Okay.
Yeah, bankruptcy or insolvency, but I mean, most of the time you have to include it.
Okay. So as a general rule, go ahead and include it. We have many people here, as I mentioned, that perhaps work in New Mexico, received a New Mexico state income tax refund from a prior year. Is the New Mexico tax refund taxable? It's a mouthful, but...
The answer is it could be if you've included it as a deduction in your previous year.
And the entire amount might not be taxable as well. And so remember, taxes are itemized deductions. If you took the standard deduction, it's not going to be taxable because it wasn't a benefit to you in prior years. If it was a benefit to you in prior years, you itemized, then most of it could be taxable, yes.
Okay.
And you actually get a 1099 from the state of New Mexico.
You will get one from the state of New Mexico. So, what was, just so people know, what is the date that everyone has to send their forms out to you? Say, for instance, your 1099s and your W-2s. Is there a date that your prior employer or your employer or contractor has to get those to you?
Most certainly. That's January 31st.
Okay.
Right.
And there are exceptions, but yeah.
Okay, so I think that's really important because some people say, oh, okay, I've gathered everything, I'm going to go ahead and file, thinking you have everything, and then after the fact, you end up getting one or two in, so it's best to wait.
Yes, if you're getting close to that date or if it's already past that date, most certainly contact your employer, particularly if you switch jobs during the year and you have to contact the previous employer. Make sure, because they're under the obligation to provide this form to you by this deadline.
Yeah, it's kind of a double-edged sword. You get it January 31st, but a lot of the time in the push to meet that deadline, a lot of the brokerage firms, especially brokerage accounts, they get things wrong. And so later on in the year, you could receive amended 1099, and if it's for actually more income, then you're going to have to amend your tax return if you've already filed. So it is a double-edged sword that it's so early in the year. Just be wary that you might receive that amended return. Give it to your CPA, see if you have to amend. Just be wary of that.
Okay.
Yeah, and for business owners that are responsible for these forms, particularly careful. They need to be particularly careful with their contractors. Now, not every contractor is required to get a 1099, So I believe if you're a corporation, and there's another exception, I can't remember at this point, but definitely have all your vendors fill out a W-9 when you first hire them, and make sure you have that information readily available in your accounting system. So at the end of the year, you can run the reports as to how much you've paid all your vendors, and you have the information necessary to provide those 1099s.
Okay, excellent. Now, if my accountant said that I have intangible assets and that part of it can be written off, what is an intangible asset? What is it?
Okay, normally intangible asset is a good way to say this is soft cost.
Okay.
So a good example is when you're first starting a business and you're going to incur some cost to maybe hire an attorney to write up an incorporation document for you. You might have to incur some costs for your CPA to help you set up your EIN number, and costs that are related for you to start your business. Those startup costs are normally going to be deducted over 15 years for the purposes of tax returns. Another big one that changed with the new tax law is if you're in a tech company and you have research and development expenses, those research and development expenses cannot be deducted altogether in the same year. So normally you would have to take those deductions over 15 years.
So this is actually going to be another question for you, Theo. If I am notified that I'm being audited and I cannot find all of my records, am I allowed to use estimates?
Normally, yes, but the estimates have to be reasonable, right? Okay. So there has to be some reasonable basis, and they're going to be subject to the scrutiny of your auditor. And just so you know, there normally are 3 types of audits. The basic one is just the letter audit, and that will happen to most individual clients that have relatively simple returns. With the letter audits, they will just tell you that they've either found errors in your return and they've adjusted it for you, and then they give you a new number, and if you're okay with that, you just pay the new number. Sometimes they will ask you for information, and this is particularly the case when you're claiming a child tax credit or when you're claiming an earned income credit. Okay. When you have dependents, they want to see information for you to prove that you can actually claim those persons. And it's normally pretty straightforward. Assuming you have all the documentation in hand, you just mail it over, and then they look at it again. And normally what the IRS will do is they will try to calculate your liability under different assumptions, and they will come back with something that benefits the IRS. And at that point, you can probably say, yes, I don't want to deal with this anymore. I'm going to pay the extra right. couple $100 and just be done with it, or you can appeal. There's also a interview kind of audit in which the IRS will actually cite you, and they will have you come into their office with your shoebox and kind of help you sit down with them and go
That's
through
the one that
things.
seems pretty intimidating.
Yes, and there's even one that's a little bit more intimidated, which is a field examination.
Ooh, okay.
With a field examination, they will normally give you a list of things they want to see, and they will basically cite you and send an auditor from the IRS to look at your information. If you're in that situation, it's highly advisable that you consult a CPA to help you go through that tax examination.
Okay, well, we have only about a minute left in the show, so if you can just help us wrap up real quickly within 30 seconds what the major changes are this year for taxes for those who are watching these new Trump tax laws.
Okay, I think the main thing to get out of this is, especially if you're a business owner, things have gotten more complicated for you, unfortunately. Definitely hire a CPA to go through the actual regulations to make sure you're paying your share of taxes, but you're not paying any more. So.
Okay. Well, again, we'd like to thank the El Paso chapter of the TSCPA. Thanks to our panel, our phone bank, and to all of our sponsors that have helped make this program possible. Thank you.
Investing in an accountant is absolutely one of the best tools that anyone can really have. I mean, not all accounting firms, not all CPAs are, super expensive. I mean, you can find a range of people out there that can help you. Even though someone might say, well, I need to make more money before I can actually invest in someone. I mean, we help you grow. And that's our bottom line as CPAs, because we look at your numbers, we want to help you grow. So you may not be at that point where, you're making hundreds of thousands, and that's completely fine.
I think the most important thing is the commitment to being a professional in the community. El Paso is an exciting city. It's been growing a lot in the last 10 years. And I think El Paso is in great need of qualified professionals that can help their businesses grow and become better. So as a CPA, I felt I had the good opportunity to bring those kind of skills into my community and to the businesses here locally.
The Texas Society of Certified Public Accountants is a nonprofit representing Texas CPAs in public practice, business and industry, government, and education.